Hello, today I want to talk about the cyclically adjusted PE ratio. Yet again, this is called the Shiller PE, the CAPE ratio, the PE10 ratio. Now, I have a lot of other videos out there about this CAPE ratio, and you can check those out if you follow these links here. Now, I also have some videos out there that say we really should be looking at earnings to price and not price to earnings, and it really does matter. You can check out the reasons behind that by following these links here. Now, here we are adjusting earnings because we're saying it's a cyclical measure. And if we're just looking at a current PE, it really doesn't tell the whole story. We get much more information if we're looking at an earnings number that has been adjusted. Well, maybe there's another way to adjust it that further improves that E part of that equation. And that is by looking at a margin adjusted cyclically adjusted earnings ratio. It's a little bit confusing, but that's what we're going to do. So can we do it? Is it a better predictor? Now, as a reminder, in general, if you start at a low CAPE ratio, your subsequent long-term returns are better. And if you start at a high CAPE ratio, your subsequent long-term returns are worse. Now, this is true throughout the world. Talked about in other videos. Here's some data to support that. Now, the question is, can we further adjust that E part of that ratio? Well, think about net profit margin. So we start with revenue, and then we have cost of goods sold and interest and tax and all these things that go away. The question is that measure also cyclical, just like the E itself is cyclical? And it turns out, as John Hussman has pointed out, that this is in fact true. This number is cyclical. And so for an index like we would use for a CAPE ratio, looking at the S&P 500 or whatever that might be, we can use corporate profits after tax compared to gross domestic product to get a sense of how cyclical this margin is, and then use that to further adjust the PE ratio. In this chart, we can see that, in fact, this measure is pretty cyclical. So what are we going to do here? And why are we going to do that? So the idea here is if the margin's really high, that means we're really profitable, right? So that is going to kind of artificially increase that E on the denominator. So that makes going to make the PE ratio, the CAPE ratio, kind of artificially low, which would lead us to believe that we're going to have good subsequent returns. On the flip side of that, if margins are really tight, then our earnings are going to suffer. That's going to be lower, and the PE ratio is going to go up. So it's going to make that CAPE ratio look different because of this kind of ebbs and flow, the cyclicality of margins. That's the idea here. So the question is, if we further adjust E to account for the margin cyclicality, will that improve our predictability? Well, it turns out yes. So as I said originally, if high PE ratio leads to subsequent lower returns and low CAPE ratio leads to higher subsequent returns, negative correlation. In fact, if we do the data, it looks like the correlation is negative 0.78. If we now make this margin adjustment to the E, now the correlation goes to negative 0.89. So it's even better if we make both of these cyclical adjustments to a PE ratio. Short one for today. I hope you like that. Happy investing out there. Thank you so much. I'm Brian Kozlowski.